What's up, YouTube? How's everybody doing today? It's a beautiful Sunday. Market is opening in 2 minutes, and I thought I would bring you this new video on the market maker's limits, how to calculate the ADR, or the average daily range. Now, this is a helpful tool. Remember that term, tool. This isn't some type of strategy. This isn't some type of, this isn't 100% perfect all-around strategy type thing. This is just a tool that will help you determine when the market may possibly reverse, where you could put your pending limit orders, and knowing where to take profit when you're in a trade. So this is more of for the intraday traders, or the scalpers, or even people that trade. You could swing trade on this as well, but it's mostly for people that trade on a daily, day-to-day basis, getting in and out of a trade, usually the same day or within a day or 2 or 3 maybe. Now, let me just throw my phone across the room here. Okay, no distractions. Calculating the average daily range. Now, this isn't going to be a 100% perfect strategy. Like I said, this is not what we're looking for. This is just a tool, okay? This is just a tool for determining where you could possibly see the market reverse or react accordingly. So what we're going to be using to find the average daily range is the Forex volatility calculator at investing.com. So you want to go to investing.com, or just type in Google Forex volatility calculator, and there's a bunch of them. Now, you can calculate over an extended period of time, whatever you'd like. I wouldn't go over 20 weeks. It doesn't make any sense to do that. You're just calculating a lot of time. You want the most recent. So I would personally, when I calculate this, I usually do 10 weeks, just me personally. So obviously you're going to have different results if you were to do 10 weeks versus 100 weeks, or 10 weeks even versus 20 or 30 weeks. That's why this isn't a strategy, more of just a tool to help you with any strategy. Okay, this is something you can leverage for any strategy. So we are currently on AUD USD. So the Aussie versus the dollar. And here it is. All right, we have a daily volatility of about 67 pips over the past 10 weeks. So what I do personally is I take a tool, the little rectangle tool, and I draw a 67 pip box. And this is my ADR calculator. This will be basically my calculator, my range, the range that the market can go before expecting a reversal. So let's test this out. Like we said, not every time it's going to work, but here it was pretty close. Here we can see almost perfect. What we're doing, just so you can have the gist of it, you don't get confused, we're calculating the daily range, right? So each of these vertical blue lines here, they're kind of hard to see, is a separation between one day and the next, right? If you're using TradingView, you can right click and go to timescale, session breaks, and click session breaks. So what we're doing is just copying and pasting this box over the range of the day, right? You can see sometimes it will be more, sometimes it'll be less, sometimes it'll be perfect, right? Here we had a perfect, nice little 67 pip, right? Upward movement from the Asian session here. It broke out of Asian session 67 pips and then reversed exactly at the top of our range here. We didn't have to manipulate anything, okay? So if you were to place a limit order, or better yet, if you're trading M or W patterns, look for M or W's at the, for example here, little M formation on the 15-minute chart. Look for reversal patterns, right? When the pair that you are calculating the range on has exceeded or has met the criteria. All right, so in this case, AUD/USD met 67 pips almost exactly. We could see the M formation reversal pattern. We know what to do there. Sell at the second leg. Now that was an easy, easy 40 pips if you took it all the way down to 40 plus pips. If you took that retracement all the way down. So like I said, this is just a training wheels, you guys. This isn't an all-around strategy, but let's keep going. There will be times as well where you can see the ADR double. Now, it doesn't happen here, but we will see it happen in the future, I'm sure. If not, just be aware that if the ADR is exceeded exponentially, so if it's coming, times 2, you can expect it to reverse at times 2, if that makes any sense, right? So here we can see price did react, right? What we'd want to do is meet up the high or the low. So in this case, if we were trading here AUD/USD, we would copy and paste our little box, and we can see the low being made here. And let's say this wasn't the low, you would just place the bottom of the range here where the low was, the wick. That's what we're looking for. So in this case, we have the low, the wick right there. So that's what we want to meet up. And we can see, in this case, it was pretty much perfect. And then once again, we can see the average daily range working right here. I should say the dealer is using the ADR in his benefit, because he knows that people like me and you are obviously calculating this. They're watching his move, right? We're watching the dealer's move, and he knows this. So what he's going to do is create these W formations, M formations, or any type of reversal pattern in that, in that sense, at these points, right? We have a 67 pip ADR right here, the ADR box, W formation at the low of that ADR box. What do retail traders expect? What do we expect? We expect a reversal. But this is just using, remember this is just using the ADR method. Like I said, this isn't a strategy. So a lot of people using this as a strategy may have gotten gotten in at this W formation here only to get faked out. Maybe, if they were lucky, taking profit here. If not, they got stopped out. But anyway, moving on to the next day. Like we said, just copy and paste this. We're just overlaying it to the next day. Some days it's more, some days it's less. Like we said, it's just an average, you guys. It's just a little tool. Here we can see once again Asian session formed. The breakout of Asian session created that high, came down. The dealer realized, okay, 67 pips. Now, who knows what his range is, all right? We're just averaging this out, you guys. So don't take this super seriously. This is just, like we said, an average. This might as well just be another indicator, okay? And you know how much I just love my indicators, right? So, moving forward, this is just, like I said, a little training wheel to go along with your strategy that you already have, okay? Or using the M or W pattern, knowing the session timings and whatnot, that's all very important. Here is a picture-perfect setup, okay? Why do I say that? Now, not only are we going with the trend here, an uptrend, we have the perfect Asian range here, perfect, nice, tight Asian range, breakout to the upside, London session, breakout, fake out, London session, come down, reverse, New York session, create that W formation at the low, at the ADR low, the average daily range, exactly, perfectly, to the point. All right, that's what we like, you guys. This is a picture-perfect setup. Okay, notice how the session timings played out. Notice how the W formation, a beautiful W formation, multiple things we're looking for. So this isn't just, all right, we're going to copy and paste this little box and hope to make some money, right? It's not just that easy, obviously. So here we are once again, using this properly, okay? This is using the ADR properly. This is the perfect setup. Why? Let me go into a little bit more in depth why this is the perfect setup and how to, how to really benefit from these reversals and how to really find the perfect setup, I should say. So, what you're going to find in Forex is, if you haven't noticed it already, Asian session will consolidate for hours and hours and hours, okay? And then come London session, the dealer will break out of this consolidation that he has made. Why is that? Because there are buy stops here and sell stops here, sell limits here and buy limits here of retail traders just waiting to catch that breakout or waiting to catch the continuation. So what he has to do is really catch them off guard. So he activates the buy stops and the sell stops and really just accumulates this movement like this, like we've talked about in previous videos, this whipsaw movement that activates buy and sell orders. And this movement here is what gives the ADR it's what makes it so valuable. Because say for example the ADR is 67 pips. So so here on AUD/USD we have 67 pips to work with before we expect a reversal, right? So let's get out of here. Let's make a nice little new day. Okay, Asian session consolidation. We have a break to the low. We have a low created, the low of the day. Still within that range of consolidation though. But then we have a spike all the way up to the top of the range. All right, 67 pips. The dealer now knows, well, now we know that the dealer doesn't have much room to work with, or so we think. Now, this is where we wait for a setup, okay? Like I said, this is not a strategy. This is just this is training wheels. This is a tool, okay? We wait for some type of setup here. Now, this will usually come in London session. If London session, this entire range is filled, most of the time you can expect a reversal, okay? If this 67 pips has been filled, you can expect London session to reverse. Because why? Because the market maker, the dealer, doesn't have any more room to work with, right? His daily room, his daily movement, I guess you could say, his daily volatility is shortened to only 67 pips. Okay, that's what we're averaging it out to be in the past 10 weeks. It's been about 67 pips, give or take a few pips every day, right? And that's just averaging. Of course, on news events, there's going to be crazy wacko patterns that that violate the averages. Of course, they're going to go hundreds of pips. Usually not, usually not 3 times the average daily range. Is what I'm trying to say. The dealer usually does not go more than 3 times the ADR. If you see the ADR extended by 3 in one day, that should be a sign to, expect something to happen. Okay, so London session. London session, we have the entire range filled, and then we have a second leg come 1 hour into London session. What do we expect? A reversal, back down, and then maybe some type of consolidation to end the day off, right? So we can sell if we have that confirmation at the range here, okay, or buy, vice versa, right? So I really hope you guys can take this with a grain of salt. This isn't a perfect all-in-one strategy like I've been saying, but it does help. It does help. You can see the dealer does have that, clearly does have a range that he works in. So we can see once again right here, here's the session break of the new day. Here's the low. This is actually a perfect example of what we have here. If I were to overlay this here, this is almost perfect, right? Okay. Anyway, we have that breakout to the range here, to the 60. We have the 67 pips met at London session. Actually, this is about New York session. London session was this consolidation here. They came New York session, maybe at the ending of London. But anyway, we did have that M formation right there. Not a perfect M, but we did have it at the aligned with the range and the sessions, sessions, right? So if we just keep copying and pasting this, obviously we're going to have some days that do not play out, but a lot of the times the days that don't play out, notice that they just keep trending. They don't really give us that fake out, but in times there will be, right? Like I showed you in the past there was that fake out beforehand. So this is just knowing the limits, guys, and understanding them. So it's funny how they can also use the limits. Let's say they used up the 67 pips for the day. So today, this day, let's say we're looking at this day here. Asian range right here, right? And then it was just a bunch of wacko right here. W formation, I guess you could call it. But then the dealer came and extended, not really extended, but broke out of that range, right? Notice the candle here too. That very aggressive candle. Notice the timing as well, right before the session changeover. This candle manipulated the spread. Any orders anywhere in here were consumed by the spread of this candle right here. I guarantee you. Then we have that M formation came down working off of the ADR of the previous day, right? M formation off of right here, the ADR, the high ADR, right, of the previous day. So notice how you can use this in so many different ways as a tool to help you understand just how the market works, just how it really helps with setting limit orders or taking profit at a certain time, and especially when you're trading like on a day-to-day basis. If you're trading, swing trading with this, it may not help you unless you calculate the weekly range or maybe the ADR times 3 as well. That could help. But anyways, I wanted to end this video by showing you just why I'm telling you that this is a tool, okay? GBP/USD out of nowhere fell 700 pips. This was just a few weeks after Brexit. So here was Brexit. We had we'll give it a 1800 pip move. And then shortly after, we had that 700 pip move. But for those that don't understand why this happened, let's check out the daily. Why did this happen? Well, we have a perfect explanation of why it happened right here. This candlestick was used to trigger any orders at that area, at the 1.195 area, right down there. So anybody that thought that Brexit was going to keep going, this momentum was going to keep going, and they had their sell stops right down here, it's the same. Check this out. So the same thing here that I was talking about here, the range, the Asian session here, and the the retail traders are waiting for a breakout with buy stops here, sell stops here. Same thing. We have the range right there, the accumulation, and then where are the buy stops and sell stops going to be? Buy stops are up here, sell stops are going to be down here, right? And you can see that one candle, not any news. There was no news. This was just a flash crash. I remember I looked at my charts that day. I did a double take. I was like, what? No news, nothing. Nothing. Thank God I wasn't in any positions. But I know a lot of people lost a lot of money that day. So, RIP, rest in peace for those accounts. But yeah, hopefully you guys did understand a little bit about how the dealer works. Obviously, this isn't a perfect strategy. There's no perfect strategies in Forex. This is just a tool, like I've said plenty of times in this video. And when you're calculating the ADR, you're obviously not going to... 67 pips is just for AUD USD when I was making this video for the previous 10 weeks. So this is just AUD USD. If you want to calculate your pair, let's say, you know what, let's do GBP USD the past 10 weeks. Actually, we'll do 5 weeks, so it's different. We have 123 pips for 10 weeks, and then 137 pip range for 5 weeks. So we can see a little variance there, not much, but you know, each pair does have a unique daily range. So just keep that in mind. That should be pretty obvious to most people, but you know, just throwing that out there. So thank you guys for tuning in. Once again, this is Forexia Pro. Peace out.